If you don't know about bonds, then you don't know about money. Now, for some reason on YouTube, this title has been used on a lot of different videos, and some are saying this is the same script. And as you can see, if I scroll down, there are tons of videos with the same exact title. They're also using the exact same graphic here, and it's got a lot of people questioning if whether or not someone's been paid off to make these videos. Here's another video. If you scroll down, you'll find more. You guys know that I've never taken money from anyone to make a video for them. So in this video, I want to explain quite simply what are bonds. And usually whenever I make a video about bonds, they perform really badly. So hopefully this doesn't. Now in the UK, premium bonds are one of the most successful savings products. That's what we think of when we think of bonds. And essentially premium bonds are a terrible example of bonds, but nonetheless, they are still bonds. Now essentially what a bond is an IOU to usually a corporation or a government. Now the government or a corporation like a company, if they want to raise money for whatever reason, they will issue a bond where someone could buy that bond. Now, when you buy a bond, you essentially buy debt. So as someone who owns the bond, there is an agreement in place that if you hold the bond for the bond duration, then at the end of it, you'll get back the purchase price of the bond plus the interest. Now, this could work in different ways. Now, with premium bonds, what you're doing is you're putting money into a system that buys government bonds. With premium bonds, the interest rate is actually the prize fund rate. So the government is giving back around 3.6% currently. But instead of giving back to the people who actually bought the bonds in the first place, this is put into a prize draw and everyone ends up with different amounts of interest. Most people end up with £0, but there are two very lucky winners who win £1 million. And the second way in which we like to think of bonds is through our brokerage, which we can get exposure to bonds. Now on Trading 212, for example, you can't buy individual bonds because they're usually sold by, the government or the corporations directly. But what you can do is to buy an ETF, which gives you exposure to certain bonds. Now we're going to come back to this because technically this is the secondary bonds market. We're going to slowly understand bits and bobs about bonds so that we can actually go back and understand how the secondary bond market works. Now this channel is just made possible through people signing up to platforms that I, talk highly about, such as Trading 212. So if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to follow the link in the description box down below. Alternatively, if you've already signed up to Trading 212 over the past 10 days but haven't received your free fractional share, all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just enter my code JUBAIR and you should receive a free fractional share. Now, before I get accused of being paid by a certain broker, I'm using this information from the IG group. As you can see from the search bar, I'm using their website. But I think the way they have explained it is fantastic. And if you would like to go and read it for yourself, I will leave the link in the description box down below, or you can just, Google it. So I briefly explained what bonds are in my own words. Like I said, it's an IOU from a corporation, a company, or a government. And as I have explained, a bond is a type of loan. So what I didn't go into is that the borrower makes interest payments at regular intervals for the bondholder. I did mention this could happen in different ways. There could be interim payments, there could be a one-off payment. It does depend on how the bond is issued. But in basic terms, here is how it works. There is a bond issuer, like a company or the government, and then there is someone who actually buys the bond. So if a company or government issues a bond worth £10,000, then the person that buys the bond will get that £10,000 back at maturity, so they will get their full amount back. However, in return for the risk and the time taken for this money, they do get back a certain percentage. Now this is called the coupon. It could be annually or it could be at different interims. But let's say a bond was issued with a 5% annual coupon. This 5% is fixed, so it doesn't go up or down. And the bond term, which explains the amount of time that, the bond will be issued till maturity, that can also be fixed. It can be a 2-year bond, 1-year bond, 10-year bond, and sometimes even 30-year bonds. Typically, what we have seen in the past is that the longer the term, the higher the interest, but it doesn't always work like that. A few years ago, we saw there was a big shakeup in the bond market, and this is because yields and terms and all sorts of stuff got mixed up, and ultimately, bonds kind of failed at that point. But over the long term, I think these videos are showing that bonds are very important. We've just taken our eyes off the ball for a bit regarding bonds. So the principal is the amount that is being lent is also sometimes known as the face value. So like I said, the coupons are paid at set amounts. This depends on the bonds. They could be annually, semi-annually, or sometimes even monthly. Now, like I also said, coupon amounts are typically, fixed, but there are some instances where that might change, and that's with index-linked bonds. And essentially they track inflation and the coupon amount can change. Whenever you're buying a bond, you're taking a certain risk, because if it's a 10-year bond and it's fixed and the interest rates go up, then essentially the bonds you have are worth less, because people can buy shorter term bonds and have a higher interest rate on that. They become more desirable and your bonds become less desirable. We'll talk about that in the secondary bond market. Now, once you have a bond, you can actually sell that bond to someone else, because once they buy it, they will receive those coupons. This allows bonds to be bought and sold in the secondary market. That's what we see with stuff like Trading 212. So like stocks, bonds have a supply and demand. I briefly went over that. So if you have a short-term bond with a very high interest rate, that's going to be in high demand because you can just buy it, wait a bit and get that higher interest. If you have a very long-term bond, let's say 30 years, and it only has 1% interest right now, it's going to be very undesirable. No one's going to want to buy that. And therefore, on the secondary market, your bonds are going to be worth less. Alternatively, you can hold that 30-year bond and get only 1% interest. But then again, for you, it's going to be less worth it because you're going to have to wait a long time and get that very low interest. Now, I don't want to make this video too complicated, so I'm going to go through the different types of bonds there are. So one really main one is government bonds. In the UK, they can be called gilts, and that's essentially when the government actually issues bonds to raise some capital. Now, the thing with government bonds is they are typically the most reliable, because most governments, for example, the UK and the US governments, they have never defaulted on their debt. So therefore, when you buy bonds off of them, you can be rest assured that there is a very small likelihood that they will default on it and that you won't get your money back. There are instances where, the bond yield might be very high, but they may be from companies or governments with low credit ratings. So there is a risk that you could lose your money buying the bonds in the first place. And in order to compensate for that, those governments may give you a higher coupon amount. So like I explained briefly, it says the same thing here, but if you want to read it for yourself, there's more information. I am not an expert by any stretch. Then there is corporate bonds. This is issued by companies that are looking for some sort of funding. Obviously, depending on the company, there could be a higher amount of risk, especially relating to their credit rating. For example, if Amazon is issuing bonds, I will have less of an issue than if a company that is new is issuing bonds. Therefore, Amazon could get away with offering less interest. Now, it is worth mentioning that when you buy a bond and assuming that the company doesn't default on it, that is technically guaranteed money. You should get back the same amount that you've invested in. Obviously, there's no such thing as guaranteed money, but there is an assumption with bonds that you're going to get your complete amount back. There are two other types of bonds, but the main ones we have covered. So these are municipal bonds and also agency bonds. Again, I'm not going to go through the last two because I honestly think they're really boring, and as an average investor, I don't think you're going to actually meet too many of those. Remember that each bond could work differently and it depends on the bond agreement. There are also zero coupon bonds. This is where you're not getting a coupon, but at the end of the bond agreement, when you reach maturity, you'll get a certain amount, and that would essentially cover any coupon payments. For example, if you bought a bond for £950 and you received £1,000 at maturity, that is essentially a 5.26% interest. Of course, you also have to consider the duration of the bond, because if that was a 10-year bond, you're not getting a 5.26% annual equivalent rate there. So this document also outlines the things that you should look for when buying a bond. But then again, I'm not really going to go very detailed into this. So there are certain things that will affect the price of a bond, and I briefly touched over them. For example, in a higher interest environment, older bonds with longer terms or bonds that have, a lower interest rate, they will become less desirable. But the opposite can happen in a low interest environment if you still have bonds with a higher interest rate and shorter term. Also, when interest rates are really low and you have a very long-term bond that is going to give you even 4%, that will be very attractive, because now you want to lock in those higher interest rates because you don't expect in the next 20 to 30 years for interest rates to go up again. So therefore, supply and demand will affect the prices of bonds. Interest rates, like I said, has a huge role in this. The bond term or time to maturity is also very important. Remember, just because it has a longer time to maturity maturity doesn't always make it undesirable. Inflation is a big one too. If inflation is higher than the interest you're getting on your bonds, it makes it quite undesirable. And of course, credit rating is very important. If you bought a bond and the company or the government reduces in its credit rating, that could make the bond less desirable, especially with a longer time period to maturity. So now that we know the basics of bonds, why do you not know anything about money if you don't know about bonds? Personally, I do not invest into bonds. This is because of my age. I'm in my early 30s, and personally, I would rather be invested more aggressively in equities such as stocks and shares rather than bonds. But bonds do make a lot of sense for people approaching or in retirement. So technically speaking, bonds are not correlated or inversely correlated to stocks and shares. This means that when stocks are going down, bonds should, in theory anyway, be the one going in the opposite direction. So when you're approaching retirement, bonds become more desirable. A financial planner would probably tell you to get more into bonds, as it could smoothen out the dips in the stock market. Now, for example, on Trading 212, if you want to get exposure to bonds, there are tons of ETFs that will do that. So the ETFs will be managed very differently, and what you're getting will depend on the fund manager. You can buy a fund that actually buys all sorts of different bonds, and the performance of these bonds can depend on market conditions. And then you can buy funds that actually aim to grow your money through buying bonds, and typically you wouldn't expect these to have the same volatility as the fund that I showed you just before, which actually buys different types of bonds. Now, like I said, a fund like this aims to grow your money through using bonds, and a fund like this will have lots of volatility, as bond yields will have a big effect on this. And then there's a whole class of different things which are similar to bonds called money market funds. Money market funds are seen more as cash-like products. Essentially, what a money market fund does is buy short-term government bonds and other bonds. So these are very close to maturity, so the risk is much lower. Typically, these also have very high interest rates, and money market funds have become very popular recently. If you look at the performance over the past year, this will give you a rough indication of the type of interest, as an annual equivalent rate that these funds have given. So make sure to check out some of my other videos, and I'll see you in the next video.